Hey everybody, it's your old pal Brian Hunt. Welcome to another episode of 60 Seconds of Risk. Now, we've talked a lot about risk and insurance over these episodes, and I've been doing this for a long time, but about 7 years ago, I first learned about what a surety bond is, and many of you probably don't know what that is either. So let's kind of walk through the basics. Now, insurance is a two-party contract between you say, I've got a house, I don't want to catch fire, and if it does, I want somebody to pay me back to build it. So you buy money, you take your money, you buy a policy with your insurance company, two-way contract, you give them money, in exchange you transfer that risk to them, something goes wrong, money comes back to you. Two-party contract. Surety though is in fact, a three-party transaction. Let me walk you through it. So let's say you're a principal. In this situation, you're a general contractor, and you're bidding on a project for a brand new school at your local school district. And so here is your client, the independent school district, as we have in Texas. You win the project, but they, beyond the contract you have, say, I want financial guarantee that my school will be built and it will not be delayed, it will actually be there on time. So in order to do that, and this is actually required by statute, the GC is going to reach out to his broker and say, hey, I need to get a bond. So the bond working with your broker, you reach out to a surety underwriter, which a surety underwriter is like a big insurance company, the large ones that like to advertise on PGA tours, the same thing. And what they are going to do, they are going to work with your client, dig through their financials, and say, okay, we have looked at their financials, they've looked at the working process, their debt ratios. We, the surety underwriter, are telling you, Mr. Independent School District, we are going to financially guarantee this project will be done on time. And so as a result, this is the third party that's guaranteeing to the owner the project will be done. And so how that's seen is a three-party contract. And the result, the bond, actual bond, is sent from the carrier to the owner. And if something, God forbid, happens, they can call on the surety underwriter and the surety team to say, they failed, I need you to make sure this gets done. Now, there's a lot of different ways that gets done, and we'll talk about that in future episodes. But in essence, this is a three-party contract that is often used on governmental contracts, can be used on private contracts, but depends upon the nature of the owner. Like all things, guys, I hope you found this beneficial. Please leave a comment or note if there's a certain thing you want me to cover on LinkedIn as far as the next episode. You can also subscribe to my channel on YouTube to find these videos. And you can also find these links on Substack and also the website formerly known as Twitter. Until next time, everybody,